This is a presentation of the Silicon Valley real estate market conditions for the week ending November 14th, presented Saturday morning, November 15th. These are the chapters we'll be going over to. There should be chapter timestamps in the description below. Here's the associated graphics with each one of the chapters. Let's get into the first data slide. Here we're looking at three major components. The first one is what I call market balance. It's the supply-demand balance. That's this gray line. And what it's basically doing is telling you if the market is more favorable to the buyers or more favorable to the sellers. The higher the number, the more favorable to the buyers. So you can see you're about 108%. So it's a little bit more favoring the buyers than normal. And it's only been at that level for about the last 13 weeks, the past quarter, midway through third quarter through midway through fourth quarter. It's been basically right around 100%, a little bit above. You can see we were way favoring the buyer more than normal. But remember, Silicon Valley is normally a superheated marketplace, so it's still a hot marketplace. It's just not as hot as it normally is. Moving on to inventory, that's the purple line. You can see purple line has been basically right at 100% of the normal level of inventory for a little bit longer. And you can see that we did have a surplus of inventory earlier in the year, basically during second quarter. And then real early in the year, we actually had a shortage of inventory. We were down at about 75% right at the end of the year of the normal level of the inventory. The normal level of inventory is comparing the same week for the last 10 years. How I determine the week is I start on March 1st, I move forward at 7 days at a time, all the way through February 21st. Then I jump forward 8 days to get back to March 1st, or 9 days to get to March 1st on leap years. And the third and final indicator on here is the number of offers. And that continues to be the story. Ever since our 2022 price correction, which happened, in my opinion, starting halfway through first quarter. Most people think it's much later in the year than that. Everybody acknowledges it was there by July. Ever since July of 2022, we've been only selling about 80% of the normal marketplace. Granted, it started off at 30% in 2023, but 2024 was mostly at 80%, and most of 2025 it's been at 80%. Sometimes we get optimistic because we had these two brief periods of time where we got up to almost 90% of the marketplace, and I sometimes have been calling 15. But regardless of the exact number, and I could calculate it, we're missing somewhere between 15 and 20% of the marketplace. Now what we're doing is looking at individual indicators. I have changed the order of the presentation a little bit on all of the slides, starting with the most significant metric, going to the least significant in some sort of logical order. So market balance is the most important thing. That's the supply demand balance, the number of listings compared to the number of buyers demanding it. You can see 13 weeks ago, and 13 weeks ago is this data point, 12 weeks ago is that data point, 13 weeks into the futures over here. This column right down here, right where the purple line ends, is, and I guess I'm a little bit off on the price reductions, is the current week, because I don't have data into the future. I have trend data into the future, but not the actual raw data. For the most part, my columns are lined up. Again, what it's basically doing is showing you that 12 weeks ago and 13 weeks ago, the balance of the marketplace was favoring the buyer, because it's up here by the blue line, which is the 90 percentile for those 10 years. The gray line is the median for the past 10 years, and the red line is the hottest, the least you'd expect for the past 10 years, favoring the seller the most. And for the most and the least, I use the 90 and 10 percentile. I don't go out to min and max, but that's pretty far out there. So right now you can see you're almost normal, but you are favoring the buyer a little bit, which is why you're on the blue side of the gray line. Same concept for each one of the different metrics. The next one is marketing time. How long does it take 3 out of 4 sellers, your typical seller, to sell? A fair number of sellers come on the marketplace and they look at offers after the first weekend because they price their home aggressively. That's something to change whether you're in a fast or slow marketplace. That's why I'm looking at 3 out of 4 sellers. You can see the quarter ago, we were at 33 days, which was much longer than normal, 40% longer than normal. Now we're still at the same number of 33 days. So it's not taking any longer or any shorter, but normally it's taking longer. So now that's only 9% longer than normal. So there's been a dramatic improvement on a percentage basis. And real estate is very cyclical. There's huge annual trends. And that's why I've normalized using weeks and comparing the same weeks from year to year. I know almost everybody else that looks at the real estate marketplace does months. There's all kinds of problems with that. One of the basic ones is the number of days that you can record transactions varies from month to month. The number of weekends in the month varies. We all know that real estate's very weekend driven, and it's really not the weekend. The weekend is where the new listings have been marketed for. The buyers come out of the woodwork, they write up their offers, but the offers are presented Wednesday and Thursday mostly. The real question is, how many Wednesdays and Thursdays do you have in the month, and how many holidays do you have? So by doing the number of weeks, always constant at 5, comparing the same 35 days to the same 35 days really helps out. Now, where I do have a little bit of a problem is where you have a non-date specific Monday holiday, like Labor Day and Memorial Day, that move around. They move a whole week, so that impacts the data a little bit, but just pay attention for the 1 week before, the week of the holiday, and the week after, and you're okay on that. Marketing time is a little bit longer than normal, but you can see that you're, just slightly above the gray line, but you're also not much separation between the gray and blue line, which basically says there's not much differential. I also have to change the scale here because you can see that the blue is off the graph. I'll make some adjustments for next week. Next thing is house price reductions. This is the seller's expectations, what they thought their house was worth versus what the market reality is, what they're telling them they're doing, how much price reduction they're doing. On average, they were taking a 1.6% price reduction 13 weeks ago, and that was 70% greater price reductions than normal. That's why you're way down here on the blue line. Now you come over here and you're 1.52, almost the exact same amount of price reductions, but now you're only 40% more. And that's again why you're still on the blue side of the gray line, but you're closer to the gray line here on a percentage basis than you were back here. Also, I haven't mentioned it yet on any of the indicators, but the reason I had the future on here is, for the most part, if you're close to the gray line, that's the trend you would expect the market to continue to follow into the future because of the huge annual cycle. Now, it doesn't always have to do that, but that's your expectation, or at least that's my expectations in the marketplace. Buyer overbid. This is an idea of how much competition the buyers are feeling when they're making their offers. So the buyer's not going to offer more than the seller's ask price if they're not fearing competition from other buyers. So you can see that a quarter ago, the overbidding was 3%, and it's normally almost 6%. So the overbidding was only half, which is why it's right down here on the blue line. You can see that we've improved, basically starting here at about 8 weeks ago through about 4 weeks ago. The market improved because we went from the blue line to the gray line, and now we've been following the gray line. Now we're at 5.5% overbidding. Normal's only 5.1%. So you're actually 0.4% of the seller's ask price higher above the ask price than you normally are for this time of the year. Inventory is one of the things. These next three are the ones that got marked down because they're really not indicators by themselves. But you can see inventory is basically right on normal. A quarter ago it was 99%. Now it's 101%. So inventory is essentially normal for all intents and purposes. Offers accepted was at 77%. Now it's at 82%. You can see it's come off the blue line a little bit. And the number of closed transactions has been following right around the blue line. It was 74%. It's now 82%. So it's improved a little bit on both offers and closings. Here's now a summary of the micro market areas. I have changed, again, the order to be consistent, and I'm trying to get the labeling consistent. So the first one is the market balance. Then you have marketing time. Balance is the supply-demand balance. Marketing time, how long does it take the typical seller to sell? Price reductions, magnitude and frequency, 2 different measures. Overbid, magnitude and frequency. And these green lines over here are comparing to normal. So those are normalized. When you clearly look at the green side of this, yes, there are some pink areas and a few red areas, but there's far more blue. So it's more favorable to the buyer than it normally is. But when you come over and look at the raw data, especially this balance, look how red that is. So it's still a seller's marketplace, even though it's favoring the buyers more than it normally does. A way to think of it is normally it's superheated and now it's just heated. Price reductions, you can see sellers are doing quite a bit more price reductions. Sellers wouldn't be reducing their price if they didn't need to sell the properties. But now look at overbidding. Overbidding is actually aggressive, which is why it's red in color. And then you have the frequency and magnitude of overbidding that I just talked about. And the reason these are orange is they're lagging indicator because you need the sale price. And then you have the appreciation since 2015. And then on the price, instead of just following the median, which is the middle number, I follow the cheapest 10 percentile on the left-hand side and the most expensive 90 percentile on the right-hand side. So you get a sandwich effect in each one of the micro market areas. And I'm just noticing too late to correct Alameda County. I got cut off there for some reason. Here's some notes for those that are following online and need a little bit more explanation. So now here's the first micro market area. And this labeling up here will be changed to market balance, but this is the market balance, the supply demand balance, the turnover rate of the marketplace. You can see that, and this is compared to the 10-year median. You can see that most of Silicon Valley is blue in color. A good part of, well, the San Mateo County coast is blue, and the northern part of the Silicon Valley is more white in color. And that, you can see over here, Alameda County is basically all white at 10% more than normal. And that means it would be favoring the buyer by 10%. San Mateo County, it really depends on what area you're in. You got San Mateo County coast, Foster City, all quite a bit above. But then you also have the expensive areas which are 10% below. So that would be a faster moving marketplace. Santa Clara County is somewhat balanced, but you have quite a bit of range. You have Saratoga Los Gatos at 87%, all the way up to Milpitas, which is now a slower marketplace than normal. A little while ago, it was a superheated marketplace, but Milpitas is at 140%. Moving on to the raw count. So this is this supply-demand balance, the raw count, the turnover rate. You can see when you look at the raw counts, most of these areas are pretty favorable to the seller. The exceptions of the blue ones, you know, over there in Pleasanton and Dublin, Livermore, and Castro Valley, 125 and 110 days. That's a pretty slow marketplace. That means you're approaching 4 months. That is a long time for Silicon Valley. It's a balanced marketplace for a lot of places in the country. Silicon Valley, I consider a balanced market to be basically 6 to 11 weeks. Here's marketing time. This is an easier to understand concept. How long is it taking the typical seller? You can see we're pretty balanced. You got a couple pink areas and a couple blue areas. And again, this is compared to normal. And then when you look at the raw counts, they're pretty reasonable. And even though Saratoga Los Gatos is at 68 and Morgan Hill's at 51, one of the things when you look at the data for long term, like I have, those are actually slower markets. You know, normally I was talking about the 6 weeks to 11 weeks. For those two micro market areas, it's more like 11 weeks to 20 weeks. It's sort of more your balanced marketplace. They're just a slower moving rate. They're sort of secondary marketplaces, even though they're very close to Silicon Valley. Here's sellers' price reductions compared to the 10-year median, but there are a lot of areas of blue. It's way more blue than normal, way more blue than it is red. That's saying that sellers are taking larger price reductions than they normally would do, or more frequent price reductions. So a larger percentage of the sellers participate, either one. And this is actually the magnitude when I read my own slide. So this is the size of them, but you can get the size because it's the average size. You can get a higher average if more sellers are participating in price reductions. Here's the magnitude of the price reductions. Now, these numbers are pretty small, and the reason for that is so many of the sellers do their homework with their listing agent before they put their house on the marketplace, so they don't have to they've already done the price reduction before they put the house on the marketplace. They come on at the right price. So the average is very low because the vast majority of the sellers do no price adjustments whatsoever. And when I say the vast majority, it's 75 to 85% of the sellers are typically not doing a price adjustment. This is the frequency of price reduction. So how common is it? It's more, and this is compared to the 10-year median. Again, it's fairly balanced. You got a few blue areas here, and then you got a couple red areas. The red areas are a deeper red than the blue is blue, but you still have roughly the same number on each side of normal. Here is what the actual frequencies are. So for Silicon Valley overall, 21% of the sellers are doing price reductions. That means 79% are not doing a price adjustment. The numbers really don't change between counties, but within the counties, and we'll use Santa Clara for an example, you go anywhere from only 9% of the sellers are doing a price reduction in Milpitas, which might sound funny since they were getting longer marketing times, but only 9% of the sellers are doing price reductions. And then you go to Saratoga Los Gatos, where almost 40% of the sellers are doing a price adjustment. You go to San Mateo County, and you have 0 in Foster City, all the way to 42% along the coast. So that's the importance of micro markets. And you can just see on the graph. Here you got a red hot area sandwiched between 2 blue areas. And then you got red, blue, red. So where you are, these micro market areas may not be exactly where the trend is, but it tells you that if you're looking in this area, the market's completely different than if you're looking in this area. Here's the overbid. So now we're flipping over and looking at what the seller's doing this compared to normal. This area is getting more overbidding than normal. So is the island of Alameda and the city of Berkeley. You're at 5% more overbidding there. Cupertino, Sunnyvale, 5% more overbidding than normal. But then if you go to the San Mateo County coast, it's at 3% less overbidding. And this is just raw numbers. It's raw percentages. And it makes sense because you're at 100% and you're taking a percentage of 100. I just went with raw count. This now is looking at the magnitude of those overbidding. So the magnitude of overbidding, I was talking about Cupertino, it was 10% overbidding. That's pretty good. Morgan Hills minus 1%. Come down here and look at Berkeley, even if you're not in that area, 21% over the seller's ask price. There's a huge difference between 21% over the seller's ask price and 3.5% below the seller's ask price. Frequency of overbidding. How common is overbidding? A little bit less common in the outlying areas. I believe this is related to the pandemic. Those areas were hotter when remote working was really common. Now that people are being asked or required to come back to work more often, they're not willing to go out to those areas. So those areas have to cool off, so they have less overbidding going on. Here's the actual raw frequency count. So you can see the number I'm seeing at 78 in Cupertino. I'm seeing an 83 down in the Berkeley, Alameda area, all the way down to 9% in the coast and San Mateo County. So again, a wide range. Here's the appreciation, and this is since the last 9 months of 2015. You can see the areas that are most doing most appreciation are the outlying, a little bit remote areas, but not far remote areas. The ones that are lower priced areas with a little bit longer commute. And that's raw percentage. So you've almost doubled your money anywhere in Santa Clara County. Silicon Valley is 85%, San Mateo County 66%, and Alameda County 71%. So clearly Santa Clara County has done the best appreciation at 99. That's almost doubling your money. 100% would be doubling your money in basically 10 years. Here's the price. This now is not market. It's basically the inexpensive homes are in the blue, the expensive areas are in the red. You have the median price in the middle. You have the cheapest 10% on the left and the most expensive 90% on the right. Here is the active inventory. So this is compared to normal. And I don't do raw count because raw count really doesn't mean anything. It's in the table if you want it. But you can see that inventory in Clara County is about 15% below normal. It's absolutely normal in San Mateo and Alameda County. That's why Silicon Valley overall is normal. So there is a shortage of inventory in Santa Clara County. Offers accepted, same concept. Raw count really doesn't mean anything, but you can see Silicon Valley is missing 18%, with Santa Clara missing 23%. San Mateo is almost perfectly normal at 98%, and Alameda County is 83%. So again, this is why I think it's absurd to talk about Bay Area real estate market conditions like the media does, because here you have three counties that are very similar and have the same workforce, and yet the differential is significant. And in fact, the whole reason I got into micro market areas is even countywide data, in my opinion, isn't accurate enough. And again, here's the summary that we went over at the beginning. Here now is, we've been talking about Silicon Valley real estate. We still have more about Silicon Valley real estate to come. Right at the end, I do the Greater Bay Area, which is 13 counties and 5 regions. If you want to join the presentations Saturday morning live, you come down here to the green root URL and add in 2025, or type in this longer Zoom meeting. I do start right at 9 o'clock, or at least I try to. I'm usually right on time. If you want an archive, you can go to the blue YouTube channel, or you can type in the shorter green root URL. The handout, it's I think 76 PowerPoint slides out of my 165 or whatever it is. You can get it by typing the green root URL, H for handout 2025, 11 for the month, and 15 for the today's date, the presentation date. Or you can type in the longer Google Drive URL, and that is current for this week. I did get it posted about 15 minutes before the hour, which is my goal. I'm Richard Callahan, real estate broker here with Creekside Realty. My contact information. I do work with buyers or sellers here in Silicon Valley and single agency transactions. I appreciate likes and subscriptions. Here is a sample of my work that I can do for buyers, customizing their search results. I can add in links to the detail of the property so you can sort the properties in a spreadsheet, move on your other criteria, and then quickly get to the details. the map link, Google Maps, so you can see how close it is to the freeway. School ratings or school names if it's important to you. And then commute times from a couple of different workplaces where you can customize the day of the week and the time that you want me to use for the default the commute home. Typically Tuesday through Thursday evenings give you the longest commute times. Let's continue on. Here's some more details. We're getting into distributions. This is marketing time. What we do now is we're looking from the 50 percentile, and the reason we could start at 50 is look how close together the data is. This is the 50% of the market sellers who come on the marketplace and they sell as soon as they're willing to look at offers. That time on market doesn't change. You can see it's right around 15, 14, maybe even 10 days, depending on whether you're super hot or super cool. I focus typically on the 75th percentile, the typical, what I call the typical seller. It's basically median of the 0.5% that's influenced by the marketplace is really how I picked it. I probably would pick 85% if I was to start all over again today. But I'll show you a little bit on some of the things on why the 85 might be too high. What we're doing now is the purple line is the current line, and then the dotted line is where we're starting off a year ago. I didn't mean to start it, but then you can see you're cooling off. So you expect longer and longer marketing times. There's the peak, the slowest market time. Now you've already accelerated. Notice how it's gotten steeper here, but shallower on the left-hand side. So notice that trend. Look how steep it is now on the right. That's an improving mark. Now it's getting shallower. That's already a cooling marketplace, even though the line looked like it continued to improve. Now you're clearly slowing down week after week after week after week. So the peak of the marketplace, the minimum marketing time doesn't last long. Now we're hitting a new slow time, basically August 2nd, and then it actually accelerated a little bit, and now it's bouncing. There's an acceleration, another acceleration. So the market on October 11th was significantly better than it was on October the 2nd. Now we're already starting to cool off. What do I expect? I expect what you saw at the beginning of this movie, which was the market slowing down. So I expect it to take longer and longer in time, higher and higher marketing times. Same concept now with price reductions. This is the largest percentage, and pay attention. I'm only looking at a 2.5% drop. So I'm ignoring the first 2.5% to take the absolute highest price reductions. Sometimes that's a typographical error. Sometimes it's a completely unrealistic seller. It gets rid of the noise. But then I only go down to the 17.5 percentile. That's the 82.5 percentile. So I'm looking at only 15% of the marketplace. Why? Because remember earlier I said between 15 and 25% of the market is the only part of the marketplace that sells. And most of the time it's more like 15 to 20%. So I'm looking at the portion of the market that does price reductions. There's no reason to look at a whole bunch of zeros. Same concept. We're starting, the purple line is where we are now. So we're pretty cool. We're quite a bit cooler than we were a year ago, which is the dotted line. And it's the dotted line we're starting off. And you can see that we rapidly cool. So that means from the purple line, I expect the market to cool. Now you're already heating up again. I guess I was showing several weeks at the bottom. Now you're heating up, and then you have a couple weeks. There's on Valentine's Day, also March 1st, right there at the peak. Least price reductions. Now you're already cooling off really fairly fast. And you can see how quickly that comes back down. And at that point, from there to the purple line, there's not much choice. In fact, right there, you're almost at the purple line. But that's a slow part. That was July 19th. Then the market took a little bit less price reductions. Notice the increase there on September the 27th. And now that's sort of the peak. And now we're already cooling off. So I expect the market from where we are right now in the purple line to start cooling off. So we're going to have some of the largest price reductions We're going to be in territory that hasn't been there for a year, but it's nowhere close to the worst, which we had back on December 27th of 2022. That was the tail end of the 2022 price corrections. Same concept on buyer competitiveness. This is how much they're overbidding. And here I look at slightly different numbers. Here I'm looking at almost the entire marketplace. I ignore the top 5%. So this is only, I'm chopping off the people that are taking the biggest 5% overbidding, and I knock off the ones that are taking the lowest 5%, which is also the biggest price decrease, because anything below this gray line is a price decrease. So this area all here is price decreasing. Concept is the same. You can see the price last year was a little bit more overbidding than this year, not dramatically overbidding. And in fact, at the high end, it's exactly mirroring, and it's pretty close to mirroring at the low end. So it's only this middle high range where there's less overbidding this year than last year. Stepping through, you can see the market really starting to cool off right about there. And that's probably why I picked it, but it's January the 3rd. And that's because we need escrows to close. So now you've already improved on Valentine's Day. There's the peak of the marketplace on March the 1st and March 15th, and still even on March 29th. Oh, there's a lag time. So then we were 5 weeks behind. So now the market's coming down. They're sort of the bottom of the market right there, August 30th. 5 weeks below that would begin basically the end of July. Now you're actually heating up, which is a weird thing to have happen. But right there, we're going to be right there on the current line. What would I expect to have? Well, I know the bottom of the marketplace is January the 1st, based on last year's data. I'd expect it to not move much for a couple of weeks. But fairly soon, once you get into December, I'd started to expect it to cool off and then heat up again early next year. And again, the reason it's lagging is we need that sale price to determine the amount of overbidding. Here's some detailed notes for those that are on their own. Here now we're looking at the marketing balance. You can see that we're slightly above the gray line, which is the normal. So we're favoring the buyers a little bit. But you can also read that we're only 40 days. We would sell out their entire inventory in 40 days in Silicon Valley, which is still a fast-paced marketplace. Here's compared to typical, the balancing. You can see it's about 8%. I think the number was slower favoring the buyers, but I usually give about 12.5% swing on each side of 100% as a considered normal. So it's a normal marketplace. It's a little bit on the upper end of normal. It's about 2/3 of the way up and 1/3 of the way away from slightly favoring the buyers. Here's the time on market. You can see that we did this huge improvement right at the end of the third quarter, beginning of fourth quarter, but we did an abrupt change, and now we're following the gray line. So at this point, what would I expect? I'd expect increased marketing time for the balance of the year. Here's now marketing time compared to typical, and this is 3 out of 4 sellers. So it's not the turnover time for the whole marketplace, but how long is it taking 3 out of 4 sellers to sell? And that's right around 109% of the normal time. So a little bit longer than normal, but not dramatically longer. This would be dramatically longer. You're taking almost twice as long as normal here. Here would be dramatically shorter. You were only taking 30%. The only time we were at that time, other than earlier this year, was back here right before the price correction of 2022. So to have a 30% of the normal marketing time and then rapidly go to 180%, you went from basically a third to almost doubling. That's a pretty significant change, and you did that in a little over a quarter and a half. Right now, we're back to normal. And that also shows you why I say the marketplace when it does shift, it shifts in a dime. Look at how dramatic that was. Look at how dramatic this was here with the pandemic. Look at where the 2022 price reduction was. And the reduction we just went through in 2025 was probably of steeper impact, because this is twice the scale of this, spreading it out, making it less steep. So this would be steeper, twice as steep as it is on the graph, and it looks steeper than it is over here. So, but we had almost no price change, where here we had a huge price change. So that's just interesting, and one of the reasons I look at so many different metrics. Here's looking at the largest 90 percentile. So I like this metric. It's other sellers that are taking the largest price reductions. What are they doing? They're taking a 15% price reductions. That is not insignificant when you're talking about a $2 million house. That's $300,000 price reductions. Here's on a percentage of normal. They're right now taking about 22% more price reductions than normal on a magnitude for the 90th percentile. And you can see they've been doing that fairly consistently ever since the 2022 price reduction. But sellers have this thing that wherever the peak market price was, they want to get more than that, even if the market's no longer there. It's hard, and that could be possibly why we're seeing such large price reductions. Ask price average. So this is just to show I'm not really playing any favorites. You're basically 1.5%, about a factor of 10 less than those that are taking the biggest price reductions. But you can still see that it favors the buyer because you're way below the gray line. You're getting closer to the blue line. Here now is the average compared to normal. So you can again see that there's larger price reductions than normal, getting close to that 12.5% that I start saying favors the buyer, not quite there. Frequency. So how common is it? We're about 21% of the sellers. I think it was 21.2% if I remember right, of the sellers are doing price reductions. Normally it'd be down here around 18.5%. So it is up about 3% more sellers are doing a price reduction than normal, but we've improved fairly dramatically from where we were right at the beginning of third quarter. Here's the frequency compared to normal. So we're basically 15, well, actually that's 10%. We're 10% more sellers doing price reductions than normal. So not a huge increase, but more than normal. Here's the magnitude of overbidding. So what are the buyers doing? You can see the buyers were, basically overbidding less than normal right here. And you can see the sharp drop in overbidding. And now they're coming back up and doing overbidding. What is that amount? That amount is 2%. Why is this 2%? Because this is the median overbid. The other number I was talking about is average. I do and jump between it, which is a little bit confusing. But for overbidding, I think it's sort of important to give you both, because the midpoint, the median, which is what we're looking at now, is going to always be somewhat close to 100%, because there's the sellers that are underbidding as well as overbidding. And it's, not roughly balanced, but it's close to be balanced, where the average overbid includes the people that are underbidding, but it's sort of like average price. Average price is always higher than the median price. Average overbidding is always higher. And it's important to sort of have a grasp. That's also why if you're a buyer and looking at what you should do, you should be looking at the distribution. And one of the reasons I include it, if you really want to love a house, you have to start looking at what's the overbidding in your micromarket area. Now, any one property, though, you have to do a CMA because it will depend on where it's priced. Because you can increase overbidding by decreasing the seller's ask price, which in Silicon Valley is almost an artificial number. It's a starting point and you typically go above. Here's compared to normal. So now you're basically 0.5% more overbidding. And I think the number was something like 5.9 versus 5.3, if I remember correctly. So maybe 0.6. So typical overbidding would be right here on, and this is raw count. So earlier the year, we were getting 4% more than we would expect. Then we went down to 3% less overbidding than you'd expect. And now we're back up to 0.5% more. Here's the frequency of overbidding. So how common is overbidding? It's basically pretty close to normal, and it's right about 60%, about 62%, maybe 61% of the sellers get more than their ask price. Here's frequency of overbidding compared to normal. So that 61% of the sellers getting at more than their asking price is about 95% of the sellers that normally get it. So you'd have to divide by 0.95 to find out what the real percentage is. Here's a quick pricing model. One is a straight line through at 11.4%. Clearly, that's becoming inaccurate. The one that's fairly accurate that isn't too bad is this one, where you've had a 12.1% price increase for 7.5 years, and the last 3.5 years have been totally flat at 0%. Here now is inventory. Inventory is exactly normal, so you're right on the top of the gray line. It's been normal ever since the middle of third quarter. Before that, you had a surplus of inventory, and right at the end of the year, you actually had a shortage of inventory. So we've seen a shortage of inventory, a surplus of inventory, and now we have normal inventory all in one calendar year. Here is compared to normal. So you're basically right at normal, and we have been that way for almost a quarter. Here's the number of offers accepted. This is showing you're missing that percentage of normal, because the normal level would be up here somewhere around 2,300 homes selling, and we're only at 1,900, it looks like. Here's on a percentage of normal, so you're right about 84% right now. And you can see that we were down at 30% in 2023. We were pretty close to 20% in 2024. And I think 2025 is a little bit higher than 80%, but I think 85% is probably a little bit aggressive on the high side. Here's some more terms on the chapter that's coming up. Now what we're doing is we're comparing the three counties. We're comparing Santa Clara County with San Mateo County with Alameda County. This is the balance. The lower the number, the more it favors the buyer. So Santa Clara County has the fastest turnover rate at 36 days. San Mateo County next at 39, and Alameda County at 46, the slowest. That's how long it would theoretically take to sell out the existing inventory, the turnover rate. But it's a measure of the supply-demand balance. Here's the marketing time, very close for all three. San Mateo County is actually the fastest, about 29.5 days. The slowest is Alameda County, about 34 days. This is how long it takes 3 out of 4 sellers to sell. You can see how consistent the three counties are timing. Yes, there is slight variation. The slowdown here in 2019 that only Santa Clara County suffered was because we had an increase. We had 2 years of appreciation in 2018 that the other two counties didn't have. So we actually did have a slowdown that the other counties didn't participate in. Here's the seller's ask price reductions. So you can see that San Mateo County is doing the most price reductions on average, almost 2%. And then you can see Alameda County is underneath San Mateo. The numbers are basically for Santa Clara about, what would that be? That'd be 1.4% price reduction. And Alameda County 1.45% in rough numbers reading off the graph. Frequency of price reductions all very close together, 21% to 21.5%. 21% of the sellers are doing their price reductions in all three counties. Santa Clara County is the highest at 22%. Here's the overbid magnitude. So Alameda County has the highest overbidding at almost 7.5% over the seller's ask price. San Mateo County is next at about 5.25%, and the least amount of overbidding right now is in Santa Clara County at 4% over the seller's ask price. Frequency of overbidding. All three counties are very close together. Again, they tend to be very similar. Right around 61% of the sellers getting more than their asking price. Here's the appreciation. Here, Santa Clara County pulls out, and it had that like 95% or 98% appreciation. The least amount of appreciation is San Mateo County at about 62%, and Alameda County slightly better at 64% appreciation based on the pricing in the last 9 months of 2015. Here's the median sold price. You can see, I draw the horizontal line so you can see that pricing is below the 2022 peak. The closest county being above is Santa Clara County, and it's below. These two numbers here are closer together than they look. I think the numbers were 1900 for San Mateo County and 1909 for Santa Clara County. Here's the same information on regular paper. That previous one was on logarithmic scale. The reason for logarithmic is you draw a straight line and you get the appreciation rate. Here's the monthly payments using the high balance conforming money for the national average. And here's active inventory. You can see active inventory is coming down in all three counties. This is the size dependent, which is why it's not by itself. Raw count is not very useful. And this is offers accepted. Same concept. Offers are starting to come down, but it's size dependent. So just raw count isn't very useful. Here's the table of real numbers. Silicon Valley overall, Santa Clara County, San Mateo, and Alameda. I highlight the 3 day marketing time metrics. And then I've moved the active inventory down to the bottom down here. More definitions for those that are on their own, that we're leaving Santa Clara County and we're going to go into the greater Bay Area. Silicon Valley is in the purple, right at 40% turnover rate. Cities, San Francisco and Marin, right at 40 days also. Then you have the North Bay and the Central Valley right here at about 70, maybe 72 days. And then you have the Central Coast, the slowest at 80 days. Marketing time. This is how long it takes the typical seller to sell. You can see North Bay and Central Coast is the longest at 78 days, Central Valley at 63 days, the cities at 48 days, and the Silicon Valley at 34 days. All of them are going up. So slowing down on the market. It's taking longer and longer to sell. Here's seller ask price. Larger price reductions in the coast and the largest, almost 4%. North Bay, almost 3%. Central Valley, 2%. Cities, almost 2%. And Silicon Valley at 1.5%. Moving on to the frequency of price reductions, you can see that the 3 areas up here are very similar. 2 of them are decreasing. North Bay and the gray is increasing. But you have 3 area regions, North Bay increasing, Central Valley decreasing, and Central Coast decreasing, all 3 at about 40%. And then you have Silicon Valley and the cities, San Francisco and Marin, both increasing at around 22% of the sellers doing a price reduction. Here's overbid. So this is the pressure the buyers are feeling. Again, you're seeing sort of a leveling off in Silicon Valley, a down movement in the cities. The cities has the most overbidding at about 9% overbidding over the seller's ask price. Silicon Valley comes in at about 7.5%. The other 3 are all below 100%. That means the buyers are actually coming in under the seller's ask price on average, with North Bay being the highest, about 99.75%, so 0.25% reduction. Central Valley being about 0.2% reduction, and the largest price reduction is in the Santa Cruz, Monterey area, the Central Coast, right at 2%.
So price reductions on average are small, but remember, it's only a small fraction. The highest number right now is about 40% of the sellers are doing a price reduction. This is the frequency of overbidding. So how common is it? Most common in Silicon Valley and in the cities, tied at about 61% of the sellers getting more than their asking price. Then you have North Bay coming in at about 36%, Central Valley at about 30% even, and the Central Coast at 22%. So even though on average, the buyers are coming in below the ask price in the Central Coast area, still 22% of the sellers are getting offers that are above the ask price. Here's long-term appreciation. The one major takeaway is the city, San Francisco and Marin, has done the least well, mostly since the pandemic. You come back here and start in 2020 and go back in time, all 5 regions are fairly close on top of one another. You go forward in time and almost immediately San Francisco and Marin ended up coming out below, and they're now only at 42% appreciation. You turn around and compare that to the Central Valley, which actually has the highest appreciation at 88%, outdoing Silicon Valley at about 86%. Central Coast is about 78%, and the North Bay is about 65% appreciation since the last 9 months of 2015. So here is the median sold price for the 5 regions. The cities is the most expensive area, followed by the Silicon Valley, Central Coast, North Bay, and the most affordable is the Central Valley. Yeah, I drew in the horizontal lines, dotted lines corresponding to the colors. That way you can come back to 2022 and see that all their areas are below their 2022 price point. Some areas are below their 2021 price point, that being both the North Bay and the cities. Everybody else, Silicon Valley, Central Coast, and the Central Valley are above their 2021 point. No region is above their 2022 price point. So clearly there's been some price corrections since that price correction we saw in February of 2022. Here's the monthly payments. Again, I used an 80% loan, reasonable estimates for property tax and insurance, and I'm using a high balance conforming rate from the Federal Reserve Bank for a national average. You can do quite a bit lower than that here in the Bay Area by getting relationship pricing as well as by getting a jumbo loan. A jumbo loan has been cheaper than conforming loans, and that changeover happened, I think, back around 2008. I should look that up and get an accurate date because it's surprising you borrow more money and they charge you lower interest rate. Here now is active inventory. You can see active inventory in all 5 regions is coming down. Started coming down the earliest in Silicon Valley. Middle of second quarter was our peak level of inventory, but all 5 regions have rolled down and come down. That's a very seasonal cycle. You can go back and look over history, how we have these upside down U-shape or maybe a lowercase n-shaped market as far as the level of inventory. Here's the number of offers accepted. Here, there are a number of offers are still going up, and they will eventually go down. As you can see, you have this very tight V at the end of the year. They are going down in Silicon Valley. They're flat in the North Bay. They're flat in the Central Valley. They're flat in the cities. They're rolled over and went down very slightly in the Central Coast. So only Silicon Valley is already experiencing the seasonal slowdown for the end of the year holidays. Here's the raw data. A little different presentation. The now column is the current week's raw count, and then the 1 week is what the percent change was from a week ago and percent change from 5 weeks ago in the different metrics across the top. We have been talking about Silicon Valley real estate market. We've talked about the Greater Bay Area. This is, again, the YouTube channel for the archive. The green root URL takes you to the exact same place. The green root URL becomes important if you want less typing, though. If you add in 2025, you can join Saturday morning at 9 o'clock, whether you can type in the longer Zoom meeting. Handouts available. I think it's 76 pages PDF this week. Green root URL, the letter H for handout 2025, 11 for November, and 15 for Saturday's presentation date. Or you can type in this much longer hitting Google Drive. Again, I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers in single agency transactions. Appreciate likes and subscriptions and any questions or comments you have. Thanks for joining. Take care. Bye for now.